Andrew, hi there. Thanks for making some time at short notice. I really wanted to talk to you this week because, like, with all this noise around tariffs, that's sort of occupied everyone's attention. And bond markets seem to be coming to the fore. But do you think things are quieting down a little bit? Um, can you analyze it yet?
It's, I mean, it is incredibly challenging. I mean, we've got the obvious effect of what I've decided to call tariff tennis. Is it going to be 150%, or is it going to be 10%? And that sort of rhetoric affects us. Um, People have talked about the repatriation trade, where the money could quit the United States, and there's talk of the impact of Section 899 in the big, beautiful bill that could put off foreign investors. There's been rumours in the last few hours about a couple of major countries doing deals to restructure their holdings of US treasuries. But just in terms of the economic data, it's been challenging. Unsurprisingly, an awful lot of importers in the US decided to fill their warehouses before the tariffs. And so we've seen a little export boom out of Asia. So actually, some of the economic data has been looking a little bit stronger, and you get this dichotomy between very depressed sentiment, and then you get actually strong economic data, which is a lot of tariff forestalling. Then we get the news that China's exports to the United States have, in theory, dropped by almost a third. But then you find that China's exports to South Africa, Canada, and a few other places actually absolutely exploded that month. And the stuff was just shipped via third parties. And I was actually told by a Canadian friend this morning that there were companies advertising transshipping services to evade US tariffs, which I would have thought was a little naive. If an economist sitting in the United Kingdom can see this is happening, I'm pretty certain the US State Department has seen this happening. So expect some sort of retaliation there. But it's been very, I think, challenging to stick to a view with this choppy economic data. But I think the thing that sticks most in my mind, and I think has been so supportive of markets, particularly in the last 6 weeks, I guess, is that we haven't seen any signs of the repatriation trade. On paper, China exported more capital in the last couple of months than it had been doing previously. The US, we run our own weekly series for the US balance of payments data, and that's actually been remarkably strong. There's been capital inflows into the US on a net basis, and not just US banks repatriating. We've seen areas of concern springing up. I do think the private channels are under something of a cloud, and focus is beginning to look at some of the auditors and the accountants and the valuations, and there's certainly some nervousness there. But even that's been, I think, ameliorated by the fact the US is a bit stronger. The US economy, I think, just took a time out in the first quarter. We had that on paper a recession. Certainly consumer spending was soft. Capital spending didn't really grow at all. That contracted a little bit. Signs that the economy's picked up a little bit over the last few months. There's been a little more clarity, and perhaps some of the rhetoric from the White House has died down. But we still don't know the long-term implications, because obviously if you've just filled your warehouses with goods, you're not going to be ordering anything in the second half of the year. And so I think we have that weakness in front of us. And for the bond markets, there have been all sorts of unintended consequences. I mean, I think we've seen Scott Bessent trying every conceivable scheme to fund the budget deficit, but a lot of understandable nervousness that I share about how the US government will fund itself past July, and perhaps we can talk about that in a moment. But other governments have reacted to this. We've seen the French government, which is unusual, issuing more debt than they needed to fund their deficit to build up their cash reserves. In Japan, the Ministry of Finance is issuing debt at about a 34 trillion yen rate when the budget deficit is less than 10. Really trying to build up some cash balances in case there's disruption in global bond markets. And at a micro level, you can understand why they've done that. But dumping that much issuance into the market and then keeping hold of the money, not releasing it back through government spending, actually represented quite a significant monetary tightening in Japan. So we've seen the yield curve shift up, money growth collapse, the banking system go to essentially zero growth, which is quite a deflationary shock for an economy that was already shrinking. So I think if we've learned anything in the last 4 or 5 months, it's that nothing's quite as simple as it seems in the headlines. There's all sorts of unintended or unexpected consequences, and you have to do a lot of sort of sorting through the detail to try and get a clear picture. But I do think things will become clearer as we get to the end of July and early August.
Mm. And so I suppose equity markets as well as bond markets, but the focus seems to be shifting towards bond markets. And frankly, that's a time when we feel quite grateful to have you around, because some of this esoterica becomes very important. Now, one individual issue which we've noticed in the last week has come to the fore is, I think it was only a few months ago, you were talking about stable coins and the impact on bond markets. And then just in the last few days, there's been some interesting articles. The BIS did a paper on this, which I think was really reflecting exactly what you were talking about a few months ago. And it's been seen as, I think it's, the stable coin nexus, if you like, is buying more government debt or government bonds than China already. It's becoming a major contributor. Did you expect it to happen this quickly?
Yes. If anything, the numbers are probably slightly smaller than I was anticipating. I wrote those papers and resurrecting one of your countrymen, John Law, there, and how this could become a source of new money into the Treasury market. And I think I was thinking it would turn out to be about $250 billion, potentially $500 billion of demand at the short end of the US curve. It seems to be much closer to the lower number. And again, there's sort of good and bad in that. It's a lower number because there seems to be less speculation in the crypto universe than we're intending. So I think I'm perhaps not ringing the alarm bells quite as much as some. I was involved in a closed door meeting with some large financial institutions last week, and the subject of stable coins did come up, and so they are being seen, I think, as a disruptive force. I don't think they're that disruptive yet because we haven't entered the full kind of John Law massive leverage cycle that I was writing about. And I think there's good and bad in that. Scott Bessent probably wishes we had, because there's been more demand for treasuries. I think in terms of financial stability, it's probably good news. Now, I think there's merit in the stablecoin structure, and there are things that, it is a natural evolution, but what we don't want is a rerun of Bank National, the Mississippi Company from the 18th century. And I won't go through that whole presentation, but that leverage speculation caused the French money supply to double and the price of food to treble, and the French Revolution followed soon afterwards. And we don't want to go anywhere down that spectrum, and we haven't yet. But I can see why people are getting concerned. And it's been nice to reissue a paper. That's a fairly productive use of my time. I don't have to do much and can send another paper out. So that has been interesting. We've also seen the US government talking up privatization, particularly, I think, selling property to private equity, but there hasn't been the funding for that. So that seems to be a bit of a stillborn project as well. And all of that means that the government is having to rely on the Treasury General Account, on running down its cash balances to meet the deficit. And by our calculations, Uncle Sam should run out of money, I would say, the 3rd or 4th week of July. Scott Bessent saying the 2nd week of August. But somewhere in that window, either the debt ceiling has to be raised, and we've got probably $500 billion of Treasury issuance within a short space of time, probably a couple of months, or the US defaults. Now, I think the default is quite unlikely, but certainly the bond markets, I think, can fear a massive dose of indigestion at that point. Bonds have had a pretty mediocre, if not bad, year to date, and that's against a net issuance of US Treasuries of about 3 billion. If we're going to try and make that 500 billion in a short space of time, then there's clearly some potential for disruption in the bond markets, late July, August time. And that's why other governments, the Japanese, French, the UK government to an extent, have been trying to get their issuance in before that event. Because I think for that third quarter could be a rocky time for bonds. Now, you do expect a policy reaction. We've been trying stable coins, privatization. The Federal Reserve bought a few bonds on the quiet and then stopped when people started noticing. The European Central Bank has resurrected the Volcker Greenspan version of quantitative easing, whereby they're anchoring the short end of the curve at low rates and providing some liquidity there and encouraging the banks to ride the curve, which has a QE-like effect. So governments are, I think, already trying, well, I saw everything that's in the kitchen sink to try and stabilise bond markets, a lot of micromanagement. But I think ultimately, if we get a sell-off in the bond markets in the third quarter, we've got to think that yield curve control, which at the end of the day is just quantitative easing by another name, could make a fairly impressive return before the end of the year. Because I don't think many governments want high yields. Fiscally, it's an issue for them. It raises questions about fiscal sustainability. But in the US, sustained high yields is going to be kryptonite to the mortgage markets. You could certainly see issues in subprime. Private credit is already struggling. That would increase the pressure on those. And even the funding for private equity starts to struggle. And those private channels have become the largest source of external financing for now what is quite a significantly cash flow negative US corporate sector. So if you disrupt the private channels, you disrupt funding to the corporates, the corporate sector has to think about austerity. That's a weaker labour market. That's an economic slowdown that then comes back through subprime and everything to start weakening the economy. So I think if we do see higher yields and pressures rising within the financial system, yield curve control will follow quite quickly. And ultimately, central banks will be creating liquidity one way or another. And I don't think they'll go back to just buying bonds outright. They'll find ways of doing it one step removed. So they don't actually have to call it quantitative easing. But I think we will see some sort of return to that. And ultimately, that proves inflationary in 18 months' time, just as it did during the pandemic. Oh. But what governments are showing is they'll do short-term things to try and stabilise the bond market without thinking too much about the long-term consequences. And that's really what upset JGBs a week or so ago. It seemed like a good idea to overissue bonds while you could. The impact on the financial system, on the bond market, and actually on the economy were pretty detrimental. I suspect in Japan, they're already having quite a big rethink about how they should behave. So this has been a very challenging environment to analyse. I think equity markets have enjoyed the stronger data. The fact that Treasury general accounts come down has created a bit of liquidity. That capital flows have persisted, that the US has still managed to attract the capital it needs to fund the current account deficit. Sort of took a big bogeyman, as it were, off the mind of the market. But we could be testing this again late July. If you've got bad news on deficit financing, potentially a US default, although I think that's a low probability. Perhaps we revisit whether foreign capital will continue to the US, particularly with some of the rumours about voluntary, if that's the right word, restructuring of bond holdings by some sovereign nations. And Section 899 within the big bill, all of those things I think will test foreign appetite for US assets at the time when the news flow could be quite dodgy. So, yeah, I think it could be an interesting August time.
So what we're seeing at the moment is sort of tremors. We've seen some soft bond auctions. We've seen the Moody's sort of rating, a few newspaper articles. And that did an episode, I think, where the Fed was, in a peculiar way, buying US Treasury debt, but it hasn't really amounted to much. And what we've had is sort of yields pushing up towards 5%. The picture you seem to be sort of painting is this is the foothills of something, and you probably don't want to be holding too much duration at the moment, and it's going to bubble around towards 5%, and schemes will be come up with to kind of pull it down. But we're not heading back to a low rate environment. It's going to be in that sort of upper 4%, and a bit of a tussle between the markets and the powers that be. Is that sort of how you characterize it over the next few months?
Yeah, I think so. At the long end, at the short end, I think we will get more rate cuts than the markets are currently predicting.
Mm-hmm.
I mean, looking in Australasia, markets are sort of pared back their expectations for rate cuts quite significantly. I think they've gone too far. The short end of these curves actually looks a bit attractive on a particularly sort of fourth quarter, first quarter next year view. But the long end, I think, yeah, I certainly wouldn't be holding a lot of duration at the moment. I'd be neutral at best. Question how aggressive you want to be there. But I think any sell-off in the long end is going to be quite detrimental to growth at a time when that tariff tennis boost to world trade is reversing and becoming a headwind to world trade. And if we get problems in those private channels, then I think US corporate austerity will start to be talked about. Now, we've got a lot of data coming out in the next 10 days about the financial health of the US corporate sector, which obviously I'll be poring over. Sort of in an analytical sense, I think this is some very important data that's going to come out, and we'll be writing about that as to how cash flow negative the US corporate sector is on average. But the trick is, of course, to then look at what the median is, because like most things in the US at the moment, with the concentration of wealth, averages and medians are quite different. And I think probably 3/4 of the US corporate sector actually is quite significantly cash flow negative, and that any disruption in the financial sector will have a pretty immediate effect. Now, it's not going to affect the 20 most cash flow generative companies, but everybody else, I think, will feel the effects quite quickly.
So that's bond markets, and more difficult question: how does that translate into equity markets, which have basically had a pretty strong rebound? It seems to have been quite technical. At some point, the momentum is going to ebb as markets really get quite expensive again. Where does that leave you on a sort of 3 to 6 month outlook?
On a 3-month view, I'm pretty cautious because I think we will see earnings under pressure. High yields typically lead to some compression in price earnings ratios. And also there's an exaggeration effect within the micro part of markets at the moment. I've been, as you know, I co-author a few papers occasionally with my colleague Ben Ashby. He's been doing a lot of work on liquidity in the markets, so not macro liquidity, but the ability of market makers to hold inventory. And the amount of capital that's been withdrawn from market-making activities over the last 10 or 15 years, partly because of regulations, partly because banks finding other things to do with the money. But we have essentially a very illiquid financial system. So a bit of buying took us back to within a couple of percent of the highs. A bit of selling could also have a quite significant effect just because of this illiquidity. Even one of the banks that I was talking to, just in their run-of-the-mill hedging operations, things that would take them an hour or two to do, have been taking a week or two. Just because there hasn't been the liquidity in the instruments that perhaps you had 10 years ago or even 5 years ago. So I think there could well be some volatility in markets that's exaggerated just by the micro makeup of the market at the moment. But the things we've really got to watch, I think, for both bonds and equities is the state of the US capital account. That if problems around the budget lead foreign investment inflows into the US to stall, then that really would be, I think, a significant cause for concern. So that's why I spent quite a lot of time trying to build this weekly estimate for the US balance of payments. Now, is the number exactly right? No, it's probably not, but I think it's in the right ballpark, and it does seem to have a decent correlation with financial markets at the moment.
Mm. So maybe a question without notice that might have a sort of bearing on this is that tariff revenue actually looks quite strong. Now that's obviously not good for the economy because it's basically a tax on corporates and consumers. So short term, could the administration get a taste for that? And long term, is that damaging for the economy? Is it enough to kind of move the dial there?
I think it goes back. I mean, I think that a bit of tariff revenue, bit of demand from stable coins, perhaps the odd privatization, the odd extending payables on the Federal Reserve, on the federal government's balance sheet. They've done all these little things, and that's well, I say they're sort of throwing everything that's in the kitchen sink at the bond market at the moment to try and suppress
Mm.
yields. I don't think ultimately when you get the issuance, it's enough, but it's helped in an environment where there's
Mhm.
been next to no issuance. I think once we get the issuance, they'll have to throw the kitchen sink at it, and in this sense, that is yield curve control, quantitative easing.
Mm.
I think
Mm.
what they've been
So
playing
overall,
around with it worked in an environment of essentially zero net issuance, and in fact, the volume or the stock of Treasury bonds outside of the banking system has declined by about $50 billion year to date. So we've actually had a very positive supply and demand flow, as it were, for the bond markets, and we've still seen some nervousness, some weakness. When that issuance arrives, I think that is a big test, and as I say, that's when they have to throw the kitchen sink at it.
yeah. The reason for talking to you now is because you have talked for a while about some of these issues which sounded esoteric. They're coming to the fore. You've said that July is what we've got to watch out for. So for us, it's about how do we sort of position around that. And I guess what you're saying is if things have been, relatively stable, but people are talking about it in an environment of zero net issuance, when that starts in July, kind of buckle up a little bit and maybe get cautious. That's the playbook, is it? As you see it
I
at the
think
moment?
so. And then, I mean, the trick will, I mean, every trade is, there's the sell and there's the buy part of it. Um, when it looks like QE is coming back, it probably is. I mean, I imagine markets will have that sort of Pavlovian response to the thought that central banks are creating liquidity again.
Mm.
Um, And so that makes me wonder if we have this rise in yields, slow down, deflationary shock to the system, that's where you actually start thinking, what inflation protection am I going to buy while it's cheap?
Mhm. Mhm.
Because if we're going into a world where the European Central Bank has resurrected Greenspan's version of QE from the early 90s or Volcker's from the Latin American crisis, I think the Bank of Japan is on the point of a U-turn with regard to yield curve control, QE. If the Fed joins in that as well, um, then I think we probably need to start thinking about how we position for a return of global inflation in the latter part of 2026. And there could be some bargains in the inflation protection area, part of the market, in the third quarter this year.
Okay,
That
well, that's
might be worth looking at.
okay. Well, that gives us sort of 3 months and then end of the year. There's a lot to happen between then. I'm pretty sure we're going to talk a lot more. In the meantime, thanks very much, Andrew, and we'll talk in a few weeks.
That was a pleasure.